Every single day, retired Americans leave money on the table simply because they do not know a few simple rules that the IRS has already written into law. They work hard their entire lives, they save carefully, they do everything right, and then in retirement they miss opportunities that could add tens of thousands of dollars to their financial security. Some of these opportunities vanish forever once you pass a certain age. That age is 70 and a half. The IRS has built a remarkable set of provisions into the tax code that activate the moment you cross that birthday milestone. Most people never discover them. Most financial advisors never mention them. And by the time many retirees learn about them, the window has already closed. If you have spent any time worrying about outliving your money, about how to stretch your retirement savings, about whether you are paying more in taxes than you should, then what you are about to learn in the next few minutes is going to feel like someone handing you a map to a room nobody told you existed. This is not about loophole hunting. This is about understanding the actual rules that exist inside the United States tax code, specifically for people who have reached this stage of life. Rules that were designed to give you more flexibility, more control, and more opportunity to keep more of what you have earned. The average American retiree spends roughly 20 years in retirement. 20 years of steady withdrawals from savings, of managing healthcare costs that can easily reach six figures, of dealing with inflation that quietly erodes the purchasing power of every dollar sitting in a bank account. During that time, the IRS takes a cut of almost every dollar you withdraw from your retirement accounts. Traditional IRAs and 401k plans are taxed as ordinary income when you pull money out. That means the government has a claim on your savings that grows larger every single year you withdraw. But here's the rule that changes everything. Once you cross age 70 and a half, a whole new set of doors opens up that most people never walk through. The first thing on that list is one of the most powerful tax planning strategies available to anyone in America, and almost nobody uses it correctly. Roth conversions after 70 and a half are something that most financial advisors treat as optional or even dangerous, but the IRS clearly disagrees with that assessment. When you convert money from a traditional IRA or a 401k into a Roth IRA after age 70 and a half, you pay income tax on the amount you convert in the year you do the conversion. That sounds like a bad deal at first glance. Why would you want to pay taxes now on money you could defer paying taxes on forever? The answer lies in what happens to that money permanently. Once it sits inside a Roth IRA, every single dollar in that account grows completely tax-free for the rest of your life and for the rest of your heirs' lives as well. There are no required minimum distributions. There is no taxation on growth. There is no taxation on qualified withdrawals. The money is yours and your family's forever, with the government permanently out of the picture. Consider a retired couple in their early 70s with a traditional IRA worth $800,000. If they never do a Roth conversion, the IRS will force them to take required minimum distributions every year, which pushes their taxable income up, potentially triggers higher Medicare premiums, and leaves a massive tax bill for their children who inherit the account. But if they systematically convert $200,000 over 5 years, while they are in a lower tax bracket than they will be in their 80s, they can transform a significant portion of that wealth into permanently tax-free money. Many retirees are surprised to learn that they can do partial conversions that keep them in a manageable tax bracket while still getting enormous long-term benefit. If this information is useful to you, please take a moment to like this video. It helps others find this content and keeps me motivated to keep making videos that could genuinely protect your financial future. The second thing the IRS lets you do after 70 and a half involves one of the most taxpayer-friendly provisions in the entire tax code. Qualified charitable distributions, or QCDs, are one of the most elegant tools available, and they are criminally underused. Here is how it works. Instead of taking a charitable deduction on your tax return, which requires you to itemize and has various limits, you can have your IRA custodian send up to $100,000 per year directly to a qualified charity straight from your retirement account. The money counts as a required minimum distribution for tax purposes, but it does not count as taxable income to you. This means the IRS treats it as if you never received it. You get credit for the distribution, the charity gets the full amount, and you pay zero income tax on the transfer. The reason most people miss this opportunity is that the charitable deduction has historically been more popular, and most tax professionals default to the standard approach without considering whether a QCD might be better for your specific situation. But for retirees who do not need the charitable deduction because they are taking the standard deduction anyway, a QCD can be far more valuable. Imagine a retiree who gives $15,000 per year to their church. If they do it the standard way, they take the charitable deduction, but only if they itemize, and their taxable income is still higher than it needs to be. If they instead arrange a direct transfer from their IRA to the charity, that $15,000 is completely excluded from their taxable income, their required minimum distribution is reduced by that amount, and they save taxes at their highest marginal rate. For someone in the 32% bracket, that $15,000 QCD might save them nearly $5,000 in federal income taxes. Over 10 years, that is $50,000 that stayed in their pocket instead of going to the IRS. The third thing the IRS allows after 70 and a half involves one of the most valuable tax rates in the code. Long-term capital gains, which are profits from the sale of assets like stocks or property that you have held for more than 1 year, are taxed at much lower rates than ordinary income. But here's the part that most people never think about. Once you cross 70.5 and your ordinary income starts to decrease as you draw down your traditional accounts, your capital gains can fall into those lowest tax brackets in ways they never could during your working years. This means that selling appreciated assets after 70.5 can be far more tax efficient than most people realize. The IRS essentially gives you a 0% capital gains rate on a significant portion of your investment profits if your total income falls below certain thresholds. For a married couple filing jointly, you can potentially have up to $94,000 in taxable income and still pay 0% on long-term capital gains. That threshold has increased over the years, and it creates a remarkable planning opportunity for retirees who want to rebalance their portfolios or cash in on investments they have held for decades. Many retirees who are not aware of this rule end up selling assets during their working years when they are in higher tax brackets, or they avoid selling appreciated assets in retirement because they assume the taxes will be punishing. But when you map out your income properly and coordinate your portfolio withdrawals with your Social Security benefits and your required minimum distributions, you can often land in a zone where your capital gains are taxed at 0%. This is one of the most direct ways the IRS rewards people for reaching this stage of life. The fourth thing the IRS lets you do, after 70.5, involves gift tax rules that change dramatically as you age. The annual gift tax exclusion allows you to give up to $18,000 per recipient per year without filing any paperwork or paying any gift taxes. But here's what most people do not realize. The IRS also lets you give larger gifts using your lifetime gift tax exemption, which has grown to over $13 million per person. Many retirees sit on significant wealth that they intend to leave to their families, but they never take advantage of this provision during their lifetimes. There are two major problems with that approach. First, the IRS requires your estate to pay taxes on assets above the exemption threshold when you die, and those rates can be as high as 40%. Second, the exemption amount is scheduled to be reduced significantly in the future unless Congress acts, which means the window for making large tax-free gifts may not stay open forever. After 70.5, many retirees are in a perfect position to begin systematically moving wealth out of their taxable estate and into the hands of their loved ones while maintaining control over the assets during their lifetime. This can be done through trusts, directly to individuals, or through education savings plans. Each year you wait is a year you are not using a provision that the IRS has specifically made available to you. The fifth opportunity that the IRS creates after 70.5 involves the ability to restructure how you receive income from different accounts in ways that minimize your tax burden. This includes the strategic timing of when you take distributions from different types of accounts, when you claim Social Security benefits, and when you pay for certain expenses. The IRS has created a system where your tax situation in any given year is not fixed. It is something you can influence significantly through the decisions you make about which accounts to draw from and when. Here's an example that illustrates this perfectly. Two retirees both need $60,000 per year to live on. One of them pulls the entire amount from their traditional IRA, pushing their taxable income into a bracket that triggers higher Medicare premiums and reduces their qualification for certain tax credits. The other retiree coordinates withdrawals from their traditional IRA, their taxable brokerage account, and their Roth IRA in a way that keeps their taxable income in a lower bracket and preserves their access to valuable credits. The second retiree might pay $3,000 to $5,000 less in taxes each year simply by making smarter decisions about the order and timing of their withdrawals. Over 20 years, that is $60,000 to $100,000 of additional wealth that they kept rather than gave to the IRS. If you find this information valuable, consider subscribing and dropping a comment below about your own retirement situation. These conversations help everyone in the community think more clearly about their choices. The sixth thing the IRS allows after 70.5 is related to health savings accounts, and this one is especially relevant given how much healthcare costs drain retirement savings. If you have a high deductible health plan, you can contribute to an HSA, and those contributions are tax deductible, grow tax-free when used for qualified medical expenses, and can be withdrawn tax-free at any age for medical purposes. More importantly, after you turn 65, HSA funds can be used for non-medical purposes without penalty, though they will be subject to ordinary income tax if used for non-qualified expenses. However, if you use HSA funds for qualified medical expenses, which include things like Medicare premiums and long-term care insurance premiums, the withdrawals remain completely tax-free. This makes the HSA one of the most powerful tax advantage vehicles available to retirees, and it is one that gets overlooked far too often. Many people stop thinking about their HSA once they leave the workforce, but the rules actually become more valuable in retirement because of the expanded ways you can use the funds and the permanent tax-free treatment for medical expenses. If you have been contributing to an HSA for decades, that account could represent hundreds of thousands of dollars in tax-free wealth that the IRS has allowed you to build specifically for healthcare purposes. The seventh and final thing the IRS lets you do after 70.5 involves backdoor Roth conversions and something called the pro rata rule. Even after age 70.5, you can contribute to a Roth IRA if you have earned income, and you can also do a backdoor Roth conversion by moving money from a traditional IRA into a Roth IRA. The pro rata rule means that when you do a conversion, the IRS treats a portion of your converted money as taxable based on the ratio of pre-tax dollars to after-tax dollars across all of your traditional IRA accounts. However, there are strategies for managing this rule, and for many retirees who expect their tax rate to be higher in the future, accelerating Roth conversions before required minimum distributions become very large can be a game-changing move. If you have been contributing to a traditional IRA for decades and have never done any Roth conversions, you may be sitting on a significant amount of pre-tax money that the IRS will eventually force you to distribute whether you want to or not. Every dollar that comes out of a traditional IRA is taxed as ordinary income. If your children eventually inherit that account, they have only 10 years to empty it and pay taxes on everything at their own income tax rate. But if you convert that money to a Roth while you are alive, the taxes are paid by you at your current rate, the account grows tax-free forever, and your heirs inherit it with no additional tax burden. This is not a theoretical strategy. This is one of the most powerful wealth transfer tools available under current IRS rules. All 7 of these opportunities share one common thread. They are all provisions that reward you for being aware of them and using them strategically. The IRS did not hide these rules. They wrote them into the tax code and made them available to every American who reaches this stage of life. But awareness of these rules is extraordinarily low, which means that millions of retirees are leaving enormous amounts of money on the table every single year. They are paying more in taxes than they need to. They are missing opportunities to give more to their families. They are failing to take advantage of provisions that could dramatically improve their financial security in the years that matter most. If this video has made you think about your own situation in a new way, please take a moment to like it, leave a comment below with your thoughts, and share it with someone who needs to hear this information. These videos take real effort to produce, and your engagement helps others find them. If you want more videos like this one that break down the hidden rules and forgotten provisions that affect your financial future, make sure you are subscribed and hit the notification bell so you never miss an episode. Here's the most important thing I want you to carry with you after watching this. The IRS is not your enemy. It is a system of rules, and within those rules are opportunities that most people never discover. The difference between a comfortable retirement and a financially stressed one is often not how much money you have saved. It is whether you understood the rules well enough to use what the system was already offering you. Age 70 and a half is not an ending. It is a threshold that unlocks an entirely new set of tools for protecting your wealth, reducing your taxes, and giving more to the people and causes you care about. Those tools exist because the government designed them that way. Now you know they exist. What you do with that knowledge is the part that will define your financial future. Take a moment to look at your own situation with fresh eyes. Calculate whether a Roth conversion makes sense for you. Talk to a tax professional about qualified charitable distributions. Review your withdrawal strategy to see if you are timing things optimally. Every day you wait is a day you are not using one of the 7 doors that the IRS has already opened for you. You have worked too hard and saved too carefully to miss out on opportunities that are sitting right there waiting to be claimed. The moment you start paying attention to these rules is the moment you start taking real control of your financial future. And that is exactly the kind of control that creates peace of mind in retirement, freedom from financial stress, and a legacy that lasts for generations.